Hello, everybody. My name is Ali Asghari. Thank you for joining our webinar. If you could just give us a couple more minutes, we're just noticing attendees rise. We have our panelists here ready, and we have about 50 attendees, and we're expecting close to 150 attendees. So please give us a couple more minutes, and we will shortly start the webinar in about 2 minutes' time. Thank you. We've got about 650 attendees. If you could give a couple more minutes, we are going to start right at 12:04 or 12:05, 2 to 3 more minutes. Thank you very much for your patience, guys. Okay, if we are just about getting ready. We are at about 56 attendees. We're expecting a lot more to join. If you can give us one more minute, please, at 12:05, I promise to start. I know it's early, bright and early in Vancouver, and where it's lunchtime here. So hope you guys have your lunch in front of you and benefiting from this webinar, especially in Toronto, we're in shutdown. So okay, so we're just about to get started. Thank you, everybody. Hello, everybody, and thanks for joining our webinar. My name is Mir Ali Asghari, and I'm the president for Central Canada chapter. I'm here with my co-host Raman Bayanzada, who is the president of the Western Central Canada CCIM chapter. The Central and Western Canada chapters have merged hands and in collaboration with ALTUS Group are looking forward to providing our chapter members with ongoing market update with respect to the commercial real estate across Canada and major sectors. This webinar will be one of many more to come down the road. Our arrangements with ALTUS is to provide this to our members, candidates, designees, prospects, and or other professional affiliates on a quarterly basis. And we were also fortunate enough to have ALTUS Group provide a discount fee to our active CCIM members for a short period of time after this webinar. So for the next 3 to 4 weeks, there is a short window that you could renew your ALTUS or join ALTUS Group. They have great data regarding commercial real estate and some good stats. Having said that, I would like to pass the mic over to my co-host Ramon to introduce our panelists and give a quick overview of the CCIM pen. Thank you.
Thank you, Eddie, and good morning from Vancouver, BC. Raman Bayanzadeh, President of CCIM Western Canada. I'd like to also welcome all of our guests and audience from all over Canada. With over 50 chapters and 13,000 designees and over $300 billion annually in commercial transactions, CCIM Institute serves as a focal point in quality education, networking, and market services for the commercial investment real estate specialist by offering resources, enabling the commercial investment practitioner to deliver superior service to clients and customers. As Ali said, Western Canada and Central Canada are very happy to announce our partnership with ALTUS. Those in the commercial sector will know ALTUS as the leading data solutions provider in the country with offerings on commercial sales comparables, new homes data, office and industrial inventory data, as well as their development applications. We're happy to be part of all those programs and to be able to offer the market reports that Ali mentioned to our members going forward. With that, I want to thank Jason Lowe, Vice President, Go-to-Market Execution at ALTUS, for making this partnership happen. And also I want to introduce Ray Wong, VP of Data Solutions at ALTUS, who will be presenting today. Ray, floor is yours. We're very happy to have you here and welcome.
Great. And again, thank you for the opportunity to present some of our findings. So when we start talking about this, we changed the presentation or the theme up a little bit. There's been a lot of discussion on evolution, but this past few months, it's been a lot of sort of surprises in the market, and as well as what was happening sort of south of the border. A lot of what we're sort of seeing have been changes to the market, but it's evolution accelerated, especially on the office market. That we're already seeing the staff, employees, and companies using or leveraging technology. And we've also seen in the last couple of years the increased densification of office space, that the companies were starting to lease a little bit more space to account for a little bit more social distancing, just from a productivity and focus perspective. And it's the same discussion with retail each and every year. Is this a year that we get rid of brick and mortar? Will it survive? Will it change? And same thing with the industrial, with the explosion of demand for e-commerce logistics companies, especially with the Amazons and 3PLs. Again, a lot of this stuff was already in progress, and what 2020 brought with the pandemic was sort of more acceleration of the changes. It pushed the retailers that were on the borderline of being able to survive this year sort of off the cliff and to close and to go into bankruptcy. So again, those were the companies that weren't that stable to begin with, and this sort of pandemic sort of pushed them over the edge. So what we're going to go through the next 40 minutes is sort of a discussion on what we see as the major trends in the marketplace. And we're going to start off on the office market. And we're getting a lot of questions in this area that this whole work from home, even with our company, has worked really well. Productivity is actually, in some cases, actually increased. And do we really need to be in the office? So we've seen a lot of changes with increased availability rates, especially with respect to Toronto and Vancouver. And if you can remember, not that long ago, we were pushing Class A availability rates below 3% and 2% in the downtowns in those respective markets. So we have seen over the past 7 months an increase in availability rates across the board, but it's basically the sublet side that, with space cancellation, that's been really moving space upwards. And especially with Vancouver and Toronto, you're seeing that big push up. But it's not all that it seems, especially when you look at where it's occurring. And it's mainly happening in the downtown market, especially with Toronto, Vancouver, and Toronto, and less so, but it's starting to move up with Montreal, and Halifax is basically not a factor. But what we saw back in March, April, May was a lot of, well, a few either lease cancellations or mainly the smaller private companies that were trying to sublet their space, realizing that they don't need the employees to be back in the office, and they were trying to lease up their excess space. But the thing with the sublet space that was coming on was basically in Vancouver and Toronto below 50,000 square feet with sort of a mixed term left. The only thing that you were really getting was sort of the turnkey, the office build out, but in the way of term, you're looking at maybe 2 or 3 years or 18 months. So it really hasn't had that big impact on the market yet, especially with respect to rental rates. But we are seeing, probably you're seeing as well, increased incentives for showings by landlords to get tenants in to look at the space, and a limit amount of tenant inducements that's being offered. So especially over the last month, we are seeing one or two spaces at 50 or 75,000 square feet coming on. And with respect to Halifax, most of that sublet is under like 5,000 square feet. So again, not that big of an impact in the second tertiary markets, but mostly in the large markets with respect to the actual sublet space. So, but at the same time, we haven't seen the actions by the accounting firms and the banks yet, and we'll probably see that going to next year. But we've been hearing a lot of noise with the tech firms, and again, what we're seeing with the tech firms is that the Amazons are increasing their office footprint to allow for social distancing, but so there's that's offsetting some of that availability rate increase. So what does this do to the new supply? Pre-leasing remains strong, and we haven't seen any sort of cancellations on commitments. So this looks at the space that is still available. So in Toronto, of the close to 10 million square feet under construction, close to 80% of that is pre-leased, and with Vancouver, 65%. But the question that we're trying to factor in, or we have to factor in with our forecast, is that what happens to that space that they come out of? So we had a higher sort of number for just because of lack of space downtown. There's a lot of pent up demand moving that area. So that's changed a little bit. So when we look at the forecast in the market, and this is again the downtown Vancouver forecast, what we have going forward, and you see that big sort of push up in 2020 with respect to the availability rate, and as well as what we're sort of forecasting going forward, closer to about 10%, again below the 4%, 9 or 12 months ago. So this is a shift, and our forecast is based on our economic forecast as well as the employment growth from StatsCan, and the forecast is put together by our economics team as ALTUS. So we still see sort of a push up in availability rate, and the balanced market in Canada is closer to about 8%. So this is slightly above the balanced market, whereby there's ample space to lease, as well as for tenants, and landlords are still getting good rent. So that's it's a bit of a concern, but again, it's still, we're not seeing the 15 to 20% that we saw in the early 1990s as a recession. And we look at the Toronto market, similar trend with respect to the push upwards as availability rate. And the whole thing is that 9 months ago, we're expecting 6 to 8% um, as a range going into 2024. But our concern is that backfill space. There's not that pent up demand anymore, or less of it, that was going to take up some of that space going forward. So this is our key assumption survey that we survey our top clients and what they expect to see from an office rental place. Again, face rents for the large part likely won't change, but you will see some decreases. And this is a far cry. This is taking place in June, but we ran this in April, and there were bigger decreases in rents, especially with respect to the top quality space and the lower quality assets that may not be able to accommodate social distancing and the new protocols of the buildings may look at more of an increase. So it's a little bit more of a pessimistic view of the lower quality assets compared to the A or triple A space that have the allow can allow for better social distancing and as well as with improved HVAC system. But we're seeing a lot more of a trend that in the past 12 months, especially with the focus on wellness with the buildings and air quality and overall health of the uh, employees. So when we look at what this work from home, there's a lot of discussions earlier with, is there need to be downtown? Do I really have to get onto public transit and commute for an hour and a half when I'm working quite well from home, right? And whether or not there'll be a shift from the office downtown to the suburbs. And part of the things with the suburbs is lower floors. Like they can walk up with a number of suburban office rooms, 3 to 5 stories, compared to downtown where you're at 50, 72 floors. And then the amount of time it's going to take to get on the elevator and to get to your floor. Now with the upcoming, hopefully vaccine into the spring, that we're going to see a bit of a change here. But we're also seeing a big shift to, instead of just moving the people moving from downtown to the suburbs, this work from home and some of the policy changes with companies, there's a big demand and a big shift to secondary and tertiary markets like Kelowna, outside Toronto with Kitchener-Waterloo, and even to London and Hamilton. And we saw this shift with respect to affordability 5 years ago with Toronto to Hamilton. And the benefit with Hamilton now, with the people moving out there for affordability, they're actually staying there and they're actually starting up their own businesses. So the positive impact for Hamilton is that their office market is starting to come back. So we're not sure we're going to see that shift with the secondary and tertiary markets, but there's a lot more interest in moving not just to the suburbs, but into sort of an outlying community. One, what in a way of affordability, and two, a lot more bang for the buck for space. So we're gonna continue to watch this. So not only does this benefit employees, but as well as employers, especially on the tech side, who've been struggling to bring people into the larger markets and based on affordability. And now they can look at other markets like Kelowna, Ottawa, and to be able to service their employee or the talent needs. So this is an overall positive. I'm a pro downtown office, or even going back to the office just from interactive and a social perspective. The Zoom calls are one thing, but to actually have an accidental discussion by water cooler or by passing something in the hallway, you can't replicate that on the screen. So I really think that people will eventually go back to the office, but again, we'll probably see a shift there, that it won't be 100% back in the office, but more with respect to combination of 3 days at home and 2 days into the office. But I'm a strong proponent of getting people back in the office to have those discussions. I also think that there's certain productivity, certain departments in the office that don't have to be in the office. So it'll be interesting to see over the next 6 to 9 months to see how this actually shakes up. Now we're sort of shifting over to the retail side, and this is not a big surprise with the increase in e-commerce sales. Again, there's a usually we go up by 100, 120 basis points for increase in e-commerce sales or each and every year. But in 2019 to 2020, it's increased by close to 200 basis points. So you're seeing it, again, because we can't travel and a lot more staycation. There's a lot more spending, especially in the spring on home improvement items, social activities, and outdoor activities from kayaks. Personally, I'm not sure why I did this. I have three different golf practice nets in my backyard, and it's just because of having a little bit more time and to occupy that you're spending on not just what you need, but what you want as well. So this will likely continue, especially with the aspect with grocery online shopping, and that has really taken off, especially from a safety perspective. And then what we're looking at from a investment standpoint, we'll get into a little bit deeper dive on investment capital markets further into the presentation. But there's a big need for food anchor retail, and this is from our investment trend survey. So it's a survey of over 150 of our clients, investors, owners, to see where they want to focus their dollars on. And it's not a big surprise with food anchor retail continuing to creep up, and with especially regional malls and less aspect with demand for enclosed community malls. But the challenge what we have with food anchor retail is everyone wants this type of asset, and people that have this asset do not really want to sell it, and there's less product available on the for sale. But it's a big push. I mean, again, it's partially based on where the retail market is heading towards. And similar to the office front, and this is a contrast with the top quality assets with expected further decreases in rents. And you've seen a lot more sort of rent deferments in this area, non-payment, but this has forced a lot of the discussions with the landlords and tenants. One, trying to get activity back into the premises, but as well as in a way of renegotiated rents, less percentage rents, and more sort of base rents and discounts. And again, it's just about keeping them sort of in sort of survival mode for the retail side. Um, and so we anticipate a little bit more challenges in this area, but similar to the office side, I also expect that this is where we're basically social animals. So I don't think this whole brick and mortar thing is going to go away, but I think we're going to see a change in how we use retail. There's still going to be experimental. Or the experience and the demand for restaurants and interactive. But I also see that especially with the number of the pension funds institution, more intensive use of existing properties like your Yorkdales, your Bayview Village, and your other sort of regional malls, allowing for rental, residential uses and condos. And again, capturing that whole consumer on site and having that customer base, and as well as trying to increase the current value of the existing assets, and trying to increase returns in that area. So I think we're still going to see a big evolution on the retail side, but I don't think retail, to a certain extent, is going away. So the good and bad on the retail side, the Amazons continue to grow on the industrial side. The bad, it's one of my favorite restaurants is McDonald's, and even those ones are starting to shutter some of those locations. And over the next 3 to 4 months, as we go through the winter, and as Ali mentioned earlier, with the shutdown or the lockdown in Peel and Toronto, it's just about survivability with some of these restaurants and retailers. But they're a little bit more better positioned compared to April. But I think it's going to still be a struggle there, even though the subsidies are coming back. That I'm not sure it was enough to keep some of the retailers surviving, especially the small individual private family run establishments. So turning to the industrial side of it, this just doesn't change because of the e-commerce side of it. There's still a strong demand for um, for warehouse, especially the bombers over 500,000 square feet, and it's not just the Amazons, but the 3PLs. Availability rate right across Canada remains really tight, especially Toronto and Vancouver. And Edmonton and Calgary, it's still low at 7% when you compare it to the office market at downtown Calgary at plus 30% when you factor in shadow space. Halifax is a little bit higher only because of some of the older dysfunctional space in the marketplace. But even there's a shortage of quality modern space. And again, the national number at 3% availability rate remains relatively tight. From a construction standpoint, still it's active, and it's close to about 20 million square feet, but still not enough because 70% of the new construction is design build for a specific tenant. So there's not a lot of space that's hitting the marketplace. It's not going to alleviate the tightness in available space. Excuse me. And then when the forecast, this is a researcher's nightmare. How do you forecast a 3% availability rate? And we know that demand is going to remain strong in this area. The only thing we're probably underestimating in this forecast is the amount of new supply. That we should factor in a little bit more new supply to hit the marketplace. And the same factor when you're looking at the industrial availability rate. What we should see, typically Toronto hits between 8 to 10% new construction. We're at close to about 7 million square feet now of year-to-date construction. We'll see another 3 million square feet. But we need to probably push the availability rate up a little bit, the new supply number up at a higher number. Again, it's really hard to forecast because it was different from the retail and the office side, that we know that industrial will still continue to be in demand, and further growth, especially in GTA, Durham, the amount of money that's being spent on infrastructure and that growth, and from affordability standpoint. But I don't think that we'll probably see some positive growth in London to be able to service the GTA, but location is everything with some of this e-commerce, logistics, as well as access to the people and the tech people to actually run these distribution, because the focus is on overall efficiencies, and the racking stacking of moving goods within the warehouse has really changed. So again, this is a big difference from the office industrial side. Very minimal number of our respondents thought that rental rates would actually decrease, and even more so for lower quality assets. So a lot expecting no change, but we're going to see an increase in rental rates in this area, and again 3 to 5% in the GTA as well as Vancouver, just because the scarcity of space. So again, a big movement in this area. So turning to the investment market, this is not bad. We're only down by 22%. And the financial crisis in 2007, 2009, we were down by about 45, 50%. And there's still a lot of capital in the marketplace. The challenge we have is the availability of product, and as well as the bid-ask gap expectation between sellers and buyers. Owners do not want to take a loss on some of their assets, but some of them will have to if they want to move or realign their portfolio. And purchasers, to a certain extent, they're expecting some sort of discount based on the pandemic and COVID. So this is probably going to result in a little bit of a slowing of activity, but our initial numbers for going into fourth quarter, October, November, especially in Toronto, the number of transactions are actually up. Volume is down a little bit just because of the type of transactions that we're seeing. And with respect to what's selling, again, land continues to lead that area. And what we're seeing is that industrial, it's only down, again, is one of the top asset classes that we're looking at. It's only down by 1.5%. And apartments only down by 5.6%. The biggest decreases are on office over 60 or sorry 55%. But a large part has to do to the big transaction last year with the Bentall portfolio in Vancouver. So that part of that is that transaction gap. Part of it is also due to companies that are investors that are still going through their office portfolio and trying to figure out what the future demand is, and creating that sort of delay in some of the transactions. Retail is only down by 22%, right? And a large part of that is the shopping centers. That's down by 40%. But the freestanding retail, anything with development potential, anything with or redevelopment or expansion, it's only down by about 15%. So not all retail is bad, but even those assets are moving. But it, again, continues to be office and industrial. And and I know the question you're thinking, so what is that going to do to values? So this is our investment trend survey. And this anticipation survey of our over 150 of our clients, where do they see cap rates going? It's not surprising with respect to retail and office. The expectation is that it will increase in cap rates, but again, industrial and apartments, flat and slight decrease. And and definitely on the industrial side that we're still seeing some deals that are lower than last year just because of the sheer demand in that area. So one of the questions that we keep asking ourselves is that what are the sort of alternatives are we seeing? And you know what? The Canadian climate really helps us. So one of the big areas that you look at the increase in tech, you look at what's happening with online shopping, is data centers. And data centers, like Canada or anything north, just because from an operating standpoint, our colder climates allow for lower operating costs. So there's a lot more interest and this into data centers and the future growth in this area. Again, the challenge that you have with data centers is one, they're expensive to run and build, and two, in the way of finding investment assets in this area, that remains relatively tight. But again, it's definitely a little bit higher for cap rates compared to your traditional office and definitely industrial and multifamily. The other area, the niche area that I like is downsizing of with empty nesters that are moving into smaller spaces, into urban areas closer to amenities and restaurants. So the demand for self-storage. If you look at self-storage, it's really changed in the last 10 or 15 years. Self-storage used to be located in the suburb, I mean, or outlying area, chains, sort of chain link fence, and dark. If you look at some of the newer self-storage facilities, and we've seen a few redevelopment of some of the 4 or 5 story office buildings into self-storage, and they're clean, they're warm when you go in there, they're well lit, you feel safe to be in the spot, they have 24/7 security. Again, that's another area that we expect to grow just because of changing demographics and the shifts and the need for that storage as people downsize. And the other area is, the growth in online grocery shopping, from especially with Loblaws, Sobeys, and Metro, how they're spending a lot more money with respect to their warehouses and the need for cold storage. So that's a big thing that's going forward. And even with cold storage, with that new Pfizer vaccine, it'd be interesting to see the delivery of that vaccine based on negative 80 degrees Fahrenheit to be able to have that effective. So anything in that area, be interesting to see where that move towards. Okay, so the big takeaways over the next year, the bid-ask gap expectations will continue to slow the market as the expectation for investors and sellers, whether or not there will be a discount for certain property types. We've already seen some of that on the retail side. I think we're going to see a little bit more and the availability of product. Again, sellers do not, if they can help it, really take a loss on their assets, especially some of the institutions and pension funds. Workplace dynamics will continue to shift, and the big question is whether or not employees feel safe coming back to the office. I know that there's a number of concerns until we get a vaccine in place, until we see the overall whether or not leaders get back into the office places as well, and whether or not they feel safe coming on a bus or taking a subway back into downtown. So that continues to be watched. Retail continues to evolve and change, and that evolution in that area. And I'm a big, strong believer in social interaction. So again, I'm back in the office every other week for at least 1 or 2 days. So I'm itching to get back to the office in the way of social interaction. Demand's going to remain strong just from an e-commerce standpoint, and will continue to be a strong product, especially and as well as on the apartment sector. Yeah, to sum up, things will change, and some things won't be the same, but that's okay. If you look at how we've evolved over the last 9 months and how we adapted and how real estate owners and tenants have become a lot more flexible in the way of surviving as well as helping, especially the landlords helping some of the tenants surviving this pandemic. I think we're going to shift. And again, this is part of the evolution with real estate. It's not just the pandemic is pushing us, but we've been seeing a lot of these changes over the last little while. So that sort of sums up the overview. Now I'll turn it over to Jason.
Thanks, Ray. If you don't mind, I just proceed to the next slide. So Ray's gone through a lot in terms of, and I think the key words based on his summary and takeaways is throughout the fog of the pandemic. I mean, there's been a lot of, you've heard the shifts, there's some permanent change, and there's silver linings stemming out of that. I think with, just want to sort of wrap up with a couple of slides here in terms of everything that Ray's presented to you and the insights is really through a data lens, right? And looking at everything that's transpired throughout, and arguably, no better time than now, and arguably no more important critical time than now to be able to have that data lens, right? And to be able to see the things that Ray just presented to you. And so with that said, across all the markets, as you can see here, all the data that ultimately went into Ray's presentation was covered in terms of everything we track. And if we just go to the next slide, as such, being able to look at the total market in perspective provides, effectively a single source of truth, right? Looking at multi-sector, multi-market, and being able to put that all into perspective relative to everything that we're seeing, particularly during a time like the fog of the pandemic, albeit with a light at the end of the tunnel and with the vaccines, but there's still some time between now and then. If we go to the next slide, if there's anything that's probably more prevalent than ever before, is the critical importance of data. Decisions being made off data, visualization of data, but simply put, to have that data lens, right? And when you read the media, when you sort of see what's happening, when you look at all the key fundamentals and drivers within the marketplace, how do you put that all in perspective? And more importantly, how do you navigate the decisions that you make, not just for yourselves, but for your clients as you proceed forward, right? And as we've all seen, just like the case count that we're seeing, everything's subject to change. Everything, and we joked on Friday about this presentation that, Ray had to potentially make some tweaks, right, up until the last minute. Why is that? To reflect the constant change that happens, and we're all seeing with the COVID cases across the country on a daily basis. So it's important to constantly keep that into perspective. We go to the next slide, and what we're seeing here is a survey that we did, both on the Global Property Development Trends Report and also a CRE Innovation Report. And this is a report based on a market sentiment of a survey comprised of industry leaders, right, across the spectrum and globally. And so if there's anything, that we're seeing, again, more prevalent than any other time ever before, is that data is imperative. And again, I keep saying this, having that data lens, but there's challenges associated with that, right? And being able to manipulate that and to ultimately get it into the usable format that you're able to consume it and have that lens that Ray's just delivered right throughout the presentation. And just going to the next slide, normalizing all of that and being able to have it in that consumable format to be able to do so. Those are challenges. And just lastly then, with all that said, based on the feedback that we're seeing and everything that we're experiencing right now during the pandemic, on the next slide, Ray, basically what we're here to support and in appreciation of the partnership that we formed together with CCIM, and we're grateful for that. It's hopefully an opportunity to add to the value proposition that the CCIM delivers to you as both current membership and prospective members, in being able to help you put the basically the power in your hands, enable you to be sitting there at mission control and having that data lens that you can put on and make the decisions in an informed manner with the insights that you heard this morning. Thank you very much, and hopefully this is helpful for you. Turning it back to you, Ali.
Thank you so much, Jason and Raymond. That was really informative. Thank you, gentlemen. We have one question I'd like to ask on behalf of Amir Sharif. This is either for Ray or Jason. The question is, can you please ask the panel for prediction with respect to the residential sector, empty nesters, trends in government funding, and then opportunities, risks that you see in the next 2 to 3 quarters? Just before you answer that, I'm talking to some US-based investors, and they're noticing, hey, Toronto's got a lot going on for downtown Toronto. A lot of rent subsidies are happening. A lot of government subsidies are happening. So they're feeling that there might be a slide in our downtown markets. That's what I have been recognizing. What's your thoughts, and how could you address the question?
Do we have an extra half hour for this? Or
Oh, God.
So, yeah, here's the thing: is that we're watching the markets very carefully, and the concern is for people to survive over the next 6 months, and whether or not we can see more changes with the economy or economic growth. And I think all the economists are pushing with better growth in 2021. Right. And with respect to the residential, we all experienced that we sort of missed the spring cycle with respect to that purchases, and because of some of the lockdown. I know this is different across Canada, where Vancouver wasn't really under that lockdown. You saw that, and transactions still continue to occur. So in the way of that, some of that pent up demand, we are seeing improving sales that you're seeing on the residential side, but we're also seeing some challenges on the condo side, especially in similar to where the office market is going in the downtown, the urban areas. And partly that was also due in Toronto to that sort of shift with Airbnb. And some of them shifted to sort of long-term rental. The other ones sort of decided to put the condos in the market. So we're going to see some softness in that area. So the expectation is that in the spring that we probably will see some sort of minor slowdown in the marketplace, and there's always that sort of inventory catch up with the builders as well. And whether or not we have another sort of lockdown where we sort of stop construction in Toronto and some of the other markets and Montreal. So we're a little bit optimistic with residential and whether or not there's that discussion whether or not there's a bubble on the residential side but we anticipate a little bit of a slowdown and not the frenzy activity that we saw in the last 4 or 5 months, but it remains to be seen with respect to the spring market. And again, depending on what happens to the pandemic and when the vaccine goes out.
Thank you very much. One other question we have is from Michael Shilton. His question is how detailed are these stats for ALTUS software when it comes to the Greater Vancouver area in comparison to, say, the Fraser Valley, various asset classes? Will they be able to differentiate different cap rates, say, for apartment rentals or multi-units from Greater Vancouver area as opposed to, compared to the Fraser Valley market assets? Is it how detailed is that?
Jason, you
Yeah,
want me
yeah.
to?
So go ahead, Ray.
Yeah, it's very detailed because all the data that we have is on a building by building transaction basis, and you can come up with those comparables on the cap rates and the rents, and definitely geographical because you can actually map your own area that you want to be able to run a search, and that's also on the listing side, properties for lease. You can create your own stats and analysis based on your own boundary parameters, and especially on the building side, we go back at least 10, 15 years. So you can look at vacancy rates for one particular building if you want to go that granular, or you can show or create a submarket or use our submarket information. But it's pretty well detailed. But the only caution there is that we try to get cap rate information as much as possible, and part of it is cooperation, part of it is providing that with when we're speaking with the industry. So we try to get whatever available information and the cap rates, but we also want to make sure that the information is verified. We're not going to put a cap rate or a rental rate in the system unless it's been verified with the participants in the transactions.
Perfect. So just to add on to that, they have the ability to narrow down various different asset classes, industrial, office.
Yep, absolutely.
You have that broken down in different markets, being Greater Vancouver area and Fraser Valley. Would that be two different markets or one market?
That would be one market. So the Greater Vancouver area would encompass all that. And maybe just to look at it at a higher level, and that's sort of like the importance of all this, is to have it nationally consistent, right? Across all the markets, whether it be the greater market or the sub-markets thereof.
I use ALTUS for my personal use, and it's in the greater market in the Toronto area, and it's awesome. Retail, industrial, office, all the broken down, the price per square foot, cap rate, and a quick little overview of the financing detail description really gives a good perspective of what happened with that opportunity, whether it's now or 10 years from today. It's a good overview of that. So kudos to you guys. I don't have any other question. I'd like to pass it on to Ramon for
one maybe question for Ray, and you kind of touched on this, like a lot of the markets, even office and retail, we thought earlier in the year that it might be much worse than it is. And they've taken hits, but it's not as bad as maybe the previous recessions that you mentioned. From your surveys, your data, or speaking to other industry professionals, do you see that holding power going away? Like, is there any indication that some of these owners are running out of capital or holding power, and in sometime in the future we might see much more urgency and desperation in needing to sell?
It depends on the economy. Again, we're anticipating with our ALTUS economics group better growth than we've seen this year. And again, it's based on a bunch of factors. With it's nice to see every day that another announcement about another vaccine, and we're getting closer. And whether or not something else happens over the next 3 to 4 months that may change that's going to disrupt, because even with we're saying industrial is really good, but at the same time it's also based on the logistics and other lockdowns on a global basis, and whether or not we can actually get those goods or those finished goods in Canada to actually transact. So over the next 3 to 4 months, that be interesting to see whether or not the pandemic gets worse or it gets better, and whether or not there's a lockdown, and that may slow down the growth in early next year. And I see more challenges with some of the private players that don't have some of those deep pockets that the institutions of venture have in the way of some sort of reserve fund. And we have seen on the retail side some of the transactions. The one, I said that retail is bad, but not that bad for on the smaller freestanding assets. But I also think that that's where some of the stress was occurring, and that some of those owners actually had to sell. But it's not a huge trend right now. It's sort of the one-off properties that we're dealing with. But if the economy gets worse over the next 3 months, we probably will see more sort of private or independent players put some of their assets for sale. Like even industrial. Industrial is great, but small bay industrial that were sort of focusing on the niche retailers, the hospitality side, they took a hit. So in the way of deferments, overall industrial did well, but the small bay industrial, that's where we actually saw 10 to 15% rent deferments for that asset class. And especially with those industrial that offer other uses like a dance studio or a gym, that with the lockdown, there were certain limitations that they were barely surviving in those industrial premises. So you can find some of the weak performer assets in some of the other types as well. But overall, we think that it's heading in a positive direction. But again, we can be surprised. Again, back in March, when I was told to go home, that I was expecting 2 weeks, and it's been 9 months. So again, we're continuing to be surprised with this year.
Thank you.
Yeah, thank you for that.
Thank you. We have one more question from Eugene Klein, and then we'll have closing remarks from Ramon. During the second wave, the question is, how many tenants have shut down door? Do we have a stat of that, or how many tenants have been actually seeking rent relief? Have we been seeking that? Do we have that information?
Well, we don't, but there's a number of retailer associations that they're touting 30 or 40% closures, but it's not just the closures. We're putting together a retail blog right now, and it talks about also new retail tenants that have come into the market. So it's not all been negative. It's been more on smaller players or the family-run individuals or the private side that we've had that concern, and even HBC and their constant court challenges with rent deferment or non-payment. So again, I think we're going to see a little bit more shakeout on the retail side. And the office side, again, we've seen some cancellations. So they've basically walked away from a lease and just paid a penalty just to avoid that 5-year commitment. But one thing I sort of missed on the office side, it's all about flexibility. So that, when I first came into this industry, it was 10, 15 years was the norm. Now it's probably 3 to 7 years, allowing for more flexibility and probably more dependent on co-working space so that they don't have to commit for 5 years, but expand and need as it needed, rather than pay for space that they don't use. So again, we're going to probably see a little bit more challenges with some of the tenants on definitely on the office and retail side.
Perfect, perfect. One last thing before we go. I know it's the last question. I want to respect your time. We have this for another 2-3 minutes. The question was for other members. Could you please elaborate the offering for this discounted member fee that you guys are extending for a 3 to 4 week period to join ALTUS Group, and what is that? What is that savings and the promotion, please?
Yeah, so the short-term and I guess sort of the kickoff promotion that we've got together that we've worked at is a 30% discount off the list price of the subscription. And that can vary, right? Depending on what the good news is that our solutions are modular. So meaning you subscribe for what you need. And it's a complete, reflection of that. So at the end of the day, it'll depend, but the minimum, sort of discount that we've offered for this, short-term basis to kick off the partnership is a 30%, depending on what it is you want.
That is awesome. Perfect. Okay. My key takeaways are industrial demand is strong and it's getting stronger. Rapid changes in retail will continue. Good luck to our downtown Toronto market. I hope they weather the storm for the next 3 to 4 quarters. I'll pass it on to Ramon for closing remarks. Thank you, everybody. Ramon, all yours.
Thank you, Ali, and thank you guys both. I had a lot of questions, and I think you answered all of it, Ray, in the presentation. So lots of interesting data. Yeah, I same as Ali. We use ALTUS in our commercial dealings and gathering the data. Excellent source. So I encourage all our members to, if they're not using ALTUS, to take a look at their products. This discount is a great discount. Both the short term and then the 20% after that. So I think that's a great value add for our members. And really, we're looking forward to having these discussions and quarterly market updates going forward. And also looking at other ways to use ALTUS to create value for our members. So thank you again, guys. Thank you for all the attendees. This was our first session. We'll update you on our calendar for next year. And looking forward to seeing you all.
Thank you.
Thank you.
Thanks, everybody. Have a good day. Bye-bye.